Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Jay Jacobs, U.S. Head of Thematics and Active Equity ETFs at BlackRock. We're talking about some very interesting investing themes for 2024. Jay, welcome. Great to have you with us today.
It's great to be back on the show, Nina.
So you recently published your 2024 thematic outlook. But before we dive into AI and all those exciting themes, I wanted to start off with the biggest ETF story of this year so far, which is the launch of spot Bitcoin ETFs. And it seems that your product, IBIT, has emerged as an early winner in this race. It has already crossed 1 billion in AUM in 4 days of trading. So congratulations on the very successful launch. So were you surprised by investors' interest in IBIT? And where are these flows coming from?
No, I mean, we're certainly thrilled with the strong start for this fund, very much focused on the long term. But I'm not surprised. We brought out this product because we were listening to our clients really over the last several years around how there was increasing interest in this asset and the focus on the ETF structure really being their preferred vehicle to get exposure to Bitcoin. So it's been a years-long process in the making to bring out this product. We're thrilled to get to this point where we have IBIT live in the market and to see the strong response. But it's not surprising given everything we've heard over the last few years. In terms of who's buying it, the great thing about all ETFs is how available it is to a range of investors. With the Bitcoin ETF, we've seen people who previously were trying to get Bitcoin exposure, but really through imprecise ways or not their preferred method. And so IBIT is really bringing more efficient access to those who have already been investing in the space. There's others who maybe wanted Bitcoin exposure, but they couldn't get it. And now that IBIT is out there, they can purchase this ETF and have it sit in a brokerage account alongside stocks, bonds, and other ETFs. And so it's really made it more accessible to those who maybe couldn't get exposure before. And then finally, there's a group of people who I think are really just starting their journey in the digital asset space. And maybe they didn't consider it really very investable until this ETF came out. And now, they're taking it, more seriously in terms of doing their due diligence to decide if it may make sense to add to their portfolio. So it's a wide-ranging audience from end investors to retail to institutions. And we are thrilled with the early response to it.
Sure. So I'm presuming a lot of those inflows are coming out of GBTC as well. But let's talk a little bit about IBIT and what makes it distinct from others very similar. There are 9, 10 other similar products available on the market. So what should our listeners know about IBIT?
Well, there's really 3 things to focus on with IBIT. The first is this allows access for investors to Bitcoin. And, we touched on this a little bit before, but, the ability to buy it in a brokerage account to sit alongside stocks and bonds is a true advantage of the ETF structure in terms of bringing Bitcoin into traditional accounts. So access is key. I think, secondly, investors have to focus on the value of convenience here. If you're trying to buy Bitcoin directly, you have to think about things like custody, hot wallets, cold storage. You might be facing very wide trading spreads on some platforms to get crypto as well. And tax reporting can be very painful in the digital asset space as well. So there's a lot of convenience in wrapping Bitcoin exposure in an ETF from a convenience perspective. But finally, and maybe kind of one of the key differentiators for us is quality. We have been managing ETFs for over 20 years at BlackRock. We have over 1,400 ETFs globally, over $3 trillion. And in a lot of ways, we think about this as just another ETF in our platform where we really want to extend that world-class technology and infrastructure, the leading risk management procedures that we have in place as well to really manage Bitcoin exposure in a similar way as how we think about managing equities and fixed income, which we've done for such a long time.
All great points. Now, going back to the biggest story of 2023, it was all about AI and the role of the Magnificent Seven stocks, which are among the biggest beneficiaries of AI bonanza. And the NASDAQ 100 index surged about 55% last year. So investors who were invested in tech ETFs and growth ETFs, they were very happy last year. For 2024, you see no dearth of opportunities despite an uncertain backdrop. But you say that investors need to focus on targeted opportunities instead of simply buying broader growth or tech ETFs. Please explain.
Well, I think just looking at it at a macro level, this is a pretty unusual environment. We had, one of the fastest rate increase environments we've ever seen in the United States in 2023. Interest rates remain elevated, and yet at the same time, we still have a lot of economic uncertainty. So, what investors may have gotten very comfortable with over the last 10 years or so of really just looking at broad asset class exposures and doing pretty well with that, given a relatively stable economy and declining interest rates, that might not be the solution looking ahead. And so we really think getting more granular with exposures and really looking for long-term opportunities is going to be key in this environment. So as you mentioned, we've really focused on this from a thematic lens of thinking about what are the next steps for AI in terms of this was a key theme in 2023, but we see a lot of opportunity in 2024 and beyond. We look at things like healthcare and where there are opportunities in healthcare innovation. And then finally, we identify rewiring of supply chains as an opportunity domestically as well as in the international front. So again, it's about getting precise in a market that is not going to be as clean cut as we saw over the last 10 years. Investors really need to look more precisely for opportunities.
Now, you mentioned 3 themes. So let's talk about these 3 themes one at a time. So as you mentioned, AI enthusiasm, that was driving the rally last year, but it appears that we are still in very early innings of AI boom, and AI adoption is just getting started. So tell us how investors can benefit from the next phase of AI adoption.
I like to think of 2023 as really being the proof of concept year for artificial intelligence. We'd seen AI as a concept really exist since the 1950s when the Turing test was introduced. And, in the last 10 years or so, we've seen things like Siri and Alexa start to get into our everyday lives. But 2023, you had the arrival of ChatGPT, generative AI platforms, and suddenly it felt like AI was here. And at the same time, though, while you saw very rapid uptake in using things like ChatGPT, you still didn't see a ton of commercialization. You see a lot of companies and governments still trying to understand what is this new technology and how could we incorporate it into our everyday processes. So when we look ahead at 2024, we really see the opportunity being in that commercialization, that next stage of AI, where we're going to see it integrated into more corporate and government use cases. What that will mean for investors, though, is this should broaden the opportunity in AI. If 2023, the proof of concept year, really benefited just the Magnificent Seven and some of those mega cap tech names, we believe 2024 will really benefit the entire value chain of AI. Some areas that I think have been overlooked, we could look at the broader semiconductor space. We certainly saw GPU manufacturers do well, but as we see AI becoming more prevalent and more use cases and more demand for AI, we're going to see an expansion to just general CPUs, kind of more everyday type of computing chips being utilized to support those AI processes. So semiconductors, we see a big opportunity there. I think secondly, digital infrastructure. AI doesn't just happen in the cloud and in thin air. AI actually happens in physical places where these powerful semiconductors are being hosted in data centers that need cooling, that need security, that need a lot of computing hardware. And so we like the opportunity in the digital infrastructure space as well with our IDGT ETF. And then finally, I think the biggest opportunity is really in the products that will be built using AI within them. And what I mean by that is AI is really a platform technology. We can see it permeating so many different sectors and industries as it starts to get applied to things like travel websites, where instead of building an itinerary on your own, you could talk to a chatbot to say, I want to go to this city at these dates. This is my budget. Go build me an itinerary. And it could now do that. Or you could imagine legal services that are drafting legal documents for you. Or even if you want to have a song or movie that really focuses on your preferences and the types of content you like to consume, you could see not just being a recipient of, what is the latest movie to come out from Hollywood, but to be almost a driver of what the latest movie from Hollywood could be based off of your interaction with AI. So there's a lot of different products and applications that we think will be built using AI. Just like if we go back 10 years ago and look at all the different types of businesses that popped up because of smartphones and because of the mobility and high-speed data that we were able to get in our pockets, enabling things like mobile e-commerce and mobile social media. So I think there's some parallels 10 years ago with the smartphone space to what we would see in AI and the types of industries that will pop up around it.
Excellent. So while technology stocks had a fabulous performance last year, it was a terrible year for healthcare stocks. And your next theme talks about medical innovations. So last year, investors were just focused on these companies which make weight loss drugs. So shares of Eli Lilly and Novo Nordisk, they surged last year, and all other stocks, most other stocks tanked. The broader healthcare sector was almost flat for the year, whereas the S&P 500 was up about 22%. So now you see, you call it a new era of medical innovation. So where do you see opportunities in the healthcare space for 2024?
I think this is really at the intersection of two megaforces that BlackRock is focused on, which is both artificial intelligence, again, as well as changing demographics. AI, just as we were saying, can be applied to so many different industries. And I think one of the most potent opportunities is in healthcare, where it costs billions of dollars to develop new groundbreaking drugs. It can take up to 10 years to do so. It's gotten expensive and timely. In a lot of ways, AI could speed up those processes and make them less expensive, because so much of it is research and data driven, and we're collecting so many more data points around patients through genetic testing and standardizing data inputs within medical systems. If you can apply that data, if you can apply AI to that data to discover new ways that different people react to different drug compounds, you can really accelerate those drug timelines. So I think the AI infusion into pharmaceuticals is a very big opportunity, even just in the operations of the healthcare space itself. You think about staffing of hospitals, tracking of equipment in hospitals, ordering the right amounts of supplies. AI could take on a lot of that infrastructure and make it a more efficient and better working system, which could also further reduce costs. So we see AI, healthcare really being one of the most interesting areas for AI to be applied. But secondly, thinking about the demographic background here, in 2024, we are going to see for the first time in the United States more people over the age of 65 than under the age of 15. And if you go back 100 years ago, there were 4 or 5 times more people over the age of 15 than under the age of 65. So this is a major demographic shift, an aging of the US population, frankly, an aging of the world population, as you see people living longer and birth rates declining. And the impact that will have on the healthcare system in particular is going to be really profound. There's a lot of ailments and diseases that predominantly impact people over the age of 65. You could think about Alzheimer's and Parkinson's, various neurological diseases, heart disease and diabetes, also impacting people who are seniors. And so the drug developers might not only benefit from using AI in their research and development, but they might also benefit from just simply more demand for their products, as we see an aging population in the United States and around the world.
All very interesting trends. Now, there are many ETFs available to investors to invest in healthcare, the broader healthcare ETFs, the broader biotech ETFs, including the one from iShares, which is quite popular. But you're talking about very specific opportunities here. Could you please talk about some of the ETFs, targeted ETFs that investors could look at for investing in these areas?
Absolutely. So, at kind of the more traditional subsector level, you mentioned, iShares Biotechnology, ETF, IBB, but we often look at this through a thematic lens of really, within the healthcare space, which companies are really at the cutting edge of some of these demographic tailwinds and technological tailwinds. And so, two funds that we are focused on for 2024 are IDNA, which is really a genomics fund looking at companies that are leading in genetic testing, genetic data, as well as building drugs that are using genetic techniques to treat certain ailments. And then we also look at our neuroscience ETF, IBRN, which is looking at companies that are developing solutions for diseases like Alzheimer's and Parkinson's. We just had one of the biggest breakthroughs in Alzheimer's drugs in about 20 years last year, and that's just starting to get off the ground. I think as we see more usage of AI, more research, more understanding of the human brain, we could see more breakthroughs in the future as well. So we're equally excited about genetic research as well as neurological research.
Now, the third theme deals with the rewiring of globalization. And we have seen that after these pandemic-driven supply chain disruptions, many companies are now seeking to nearshore, friendshore, and reshore. So they are focusing to make their supply chains safer and more reliable, even if that means paying a little bit more. So please talk about this theme and how investors can benefit from these trends.
I think the reality is this is a trend that has been underway for several years now. You look back to the global financial crisis where suddenly people were questioning kind of global financial systems. You move ahead to tariffs and Brexit. You look to COVID-19 and the disruption of supply chains there. And I think these string of events show that supply chains that previously were focused on just looking for the lowest cost forms of inputs into a supply chain now need to focus more on reliability. And so you've seen a lot of government policy around this in the United States to secure supply chains around really key industries. You can look at the Chips and Science Act, which is bringing tens of billions of dollars to building semiconductors within the United States. You can look at the Inflation Reduction Act at bringing hundreds of billions of dollars to building things like electric vehicles in North America. And you can also look to the Infrastructure Investments and Jobs Act as a over $1 trillion bill to really revitalize physical and digital infrastructure in the United States. And you put all that together, and clearly there's an emphasis on building within the United States. Now, one of the challenges, however, though, is demographics. There were about 20 million jobs added to the workforce over the last 10 years in the United States. Looking forward, that number might be more like 4 million or 5 million. So we are seeing slowing growth rates within the workforce. And yet we have these ambitions to build really important industries nearby or with trusted partners. And so what that is doing is really causing companies and governments to rethink who are we going to partner with outside the United States to secure our supply chains. One of the biggest beneficiaries so far has been Mexico. It has a large youthful population, lower cost of labor relative to the United States, of course, incredible proximity to the United States just to the south, and it also has free trade agreements with the USMCA. So you add that together, and in some ways it's a relatively obvious partner of, if we want to build more electric vehicles, we should be integrating our supply chains with Mexico to do so. But another partner that has benefited in the last few months and quarters has been India. And similar reasons, very large youthful population, lower cost of labor than the United States. You're starting to see tariffs being rolled back, and it's really just about diversifying supply chains. And so you've seen some major corporations starting to move, in particular, some of their technology manufacturing to India. And they could be a really big beneficiary of this new global supply chain system.
Yeah, you're right. There are plenty of reasons for optimism about India and Mexico. And in fact, if we look at the performance of these ETFs, I noticed that India and Mexico focused ETFs did really well last year, significantly outperforming the broader emerging market ETFs that have a lot of exposure to China. And BlackRock offers an ETF which provides exposure to emerging markets, excluding China. So that has seen a lot of interest, right?
It has, yeah. We've seen strong flows across the emerging markets suite. In particular, I think Mexico, India, and not an emerging market, but a developed market overseas of Japan. Those have been some of our leading single country funds over the last 12 months or so. All of them are somewhat idiosyncratic, but I think a unifying theme here is each of those countries does play an important role in the U.S. supply chain, and as we see this rewiring of supply chains, it certainly is beneficial to be aligned with U.S. interests.
Excellent stuff, Jay. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights.
Thanks for having me, Nina.
That was Jay Jacobs of BlackRock. Now, let's recap some of the ETF tickers that we discussed in today's interview. For the next phase of AI adoption, the semiconductor ETF by iShares is the iShares Semiconductor ETF. Ticker symbol is SOXX. And in full disclosure, I own it in the ETF investor portfolio that I manage. He talked about the digital infrastructure and real estate ETF. The ticker symbol there is IDGT. For investing in medical innovation, you can look at the iShares Neuroscience and Healthcare ETF. The ticker symbol is IBRN. And for genomics, it is the iShares Genomics Immunology and Healthcare ETF, ticker symbol IDNA. Both very interesting ticker symbols. Now, for investing in the new phase of globalization, you can look at the Mexico ETF. The ticker symbol is EWW. Or you can look at the broader emerging markets ETF, excluding China. The ticker symbol is EMXC. For investing in India, BlackRock offers iShares MSCI India ETF. The ticker symbol is INDA. Another India ETF that I like and I own in the ETF investor portfolio is by Wisdom Tree. The ticker symbol is EPI. EPI invests in profitable Indian companies. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.